Right, thank you. Good afternoon. Well, in the months following the election, the government has consistently mentioned a £20 billion black hole in the government finances, and the budget would address this issue. So today, the Chancellor Rachel Reeves unveiled the 2024 Autumn Statement, the first budget under this new government, which has been in power, as I say, since July. Ahead of the statement, the government detailed that tax rises would be required, as the Chancellor now attempts to raise an additional £40 billion in tax revenues. So I'm Diane Lewis, I'm part of the tax team in Bevan Buckland, and I'm with Matthew Denny today, who is a tax partner with Bevan Buckland. And we're just here to summarise some of the initial key points on the back of the budget that just closed down a couple of hours ago. So it's kind of a whistle-stop tour through the headlines, really. So initially, I think the big one today is we're going to firstly open with national insurance contributions. So when the government first came into power, they announced that they would not increase income tax, national insurance, and VAT. Whilst this was true on income tax and VAT for individuals and employees and businesses, unfortunately, national insurance contributions has become a very different story for employers. Now, for employees, the rate of national insurance has been reduced since April 2024 from 8% to 6%. From 10% to 8% and 6% for the self-employed individuals. But today, Rachel Reeves announced that they would increase employers' national insurance from 13.8% to 15%. And that has quite a significant impact on employers. Matt, I'm sure you would like to discuss this further.
Yeah, this one shocked me actually. So I think historically we have employers' national insurance and employees. Not ignoring self-employed national insurance contributions for the moment, but the difference between employers and employees never used to be all that much. They sort of started life as around about 10% each. Employers went out to 13.8%, which is the highest it had been in a number of years. And Jeremy Hunt brought down employees NI from it was at a high of 12, and he brought it down in increments to 8%. So we had a quite a big difference between the employer rate and the employee rate, and in a sense, I suppose Jeremy Hunt had kind of snookered Rachel Reeves into a situation where she couldn't put employees NI up, having said they were not going to increase taxes for working people. There is a sort of a political debate on whether what they actually said was they weren't going to touch employers NI, touch national insurance at all, and that sort of became, or what we meant was employees NI, because that's what actually affects the working people. So we're not political. Everything is played with a straight bat. But that's the background of this difference. But to increase it to 15% is the highest rate we've ever had. And what I'm going to do, I'm going to share my screen. I hope people can see this. I mocked up quite quickly a spreadsheet which will help to demonstrate the. All right, I'm Di, can you see it? I'm assuming if you
Yeah, I can see this.
screen,
Yeah.
then this one here with my mouse waving around all over the place.
Yeah.
So
Yeah.
this is very simple. I haven't had a chance to recheck it, but directionally, it's going to explain to people that if you take someone on the average, this is apparently the average salary across the UK. So I've taken the average salary. The moment you don't start paying, or the employers don't start paying employers NI until you've gone over the second, what's called the secondary threshold, which currently is £9,100, and that's dropping like a stone to £5,000. So the amount that's being subject to employers NI on this average salary is going to increase by the difference between the thresholds, right? So that's gone up by the £4,100 difference. But additionally, the rate has gone from 13.8, so that's 13.8 of a lower amount, to 15% of a higher amount. So for someone on the average annual salary, the employer, not the employee is not impacted, the employer will have an increase of £861. That's before the employer's allowance. So the employer's allowance is something that incredibly some people just do not claim, not aware of it. But the employer's allowance is like a fixed amount that you get knocked off your NI bill. So if you had, I'm going to change this number and hopefully everything else will work. But if you had, say, 10 individuals who are all on exactly the same salary, the that would be your that was your employer's NI bill, 10 times that. That's what it will be. But then you knock off the employer's allowance. It was 5, it was 10 and a half. It's now going to be 10 and a half. That 10 and a half, I believe we used to have a situation where that employer's allowance was disappeared if you had too many people. If your NI bill was more than £100,000 a year, so for bigger employers, you didn't even get the 5. I believe.
And it's also directors of sole companies, sole company directors, they don't have it.
And we'll come on to them because they're the ones that are. I kind of understand why they might be affected on a sort of political perspective, but I believe everyone is going to get that 10 and a half, regardless of how big an employer you are. So the reason I've done it in this way is, if you had, I think it was 6. So if you're a smallish business, I know this is based on 6 people on the average salary. That's never going to work like that. But I don't know what an average small business has in terms of number of people and spread of pay. But it'll give you a sense. If you've got 6, if you had about 6 people on about the average salary, then, or whilst you would have an increase at this level, you would more than claw it back on the increase in the employer's allowance. So smaller businesses won't be impacted, but if I change that to 100, ouch, ouch. Okay, if it's a company, that will be deductible for corporation tax, and so the net cost would be more like 60,450 in this example. So that will give a bit of a flavour of quite how heavy this can be, not just on small businesses, but some small, medium-sized businesses. That this is going to be quite painful. I think there's going to be a reaction. I suspect it will be because employees have benefited from the reduction in employee NI, and employers are going to suffer the increase. I suspect that this will sort itself out in pay awards, so you can see that people will not be getting pay rises next year, and employers will say, well, look, to be honest, you've had a pay increase because the employees' NI has gone up, and now we've got to pay more, so we haven't got it. So for directors, yes, you mentioned directors, they don't get the employer allowance, and of course that is this is what a lot of directors will take a small salary, which they don't typically pay very much or if any NI, and they'll take the rest as dividends. So that will become interesting. And I think, in fairness to that position, during COVID, when everyone was after the sort of the COVID support, there were a lot of small companies up in arms because they were getting a percentage of not very much under furlough, but they had chosen to take their income in a much more tax efficient way, and that kind of, I suppose, redresses some of the balance. So yeah, that's a quick summary of the increase in employers' NI.
Yeah, right. So we also, in our previous webinar, we covered capital gains tax. Now, there was a lot of doom and gloom around what we were thinking the rates might end up with and the impact of capital gains tax. But in fact, all the government have done this time is increase the rate for other assets, which was chargeable at 10 and 20%. So say shares, or other assets. They brought it in line with the tax charge on residential properties, which is currently 18 and 24%. Now that change has come into effect immediately. It's with effect from today. So there's been a lot of people, landlords generally, selling properties, selling shares because they were worried about this massive increase in capital gains tax. Whilst there has been an increase, it's not been as painful or substantial as we were expecting, I think, to be fair. So that's your first one. That really impacts individuals generally. Then you've got your entrepreneurs
Yeah.
with business asset disposal relief, which is when they're selling their business. That rate will increase from 10% to 14% from April 2025, and then it'll increase again to 18% from April 2026. But they have retained the £1 million lifetime allowance. So there's a couple of changes, not as drastic as was expected, but still a change.
Yeah, and the key thing there, I was just double checking that because it's quite confusing
Mm,
with these dates.
mm,
That rate from 20 to 24 is
mm.
immediate.
Yeah,
That is immediate. So
yeah,
like what we were sort of expecting, if they were clever, they may actually have delayed it because
yeah,
people sell more stuff and they raise more quick revenue. But let me explain that. So the reason we had two rates was because if you were a basic rate payer, to the extent that the gain fell in the basic rate band, you paid 10%. And to the extent it fell into your higher rate band, it was 20%. So, if, for example, you had, say, £30,000 of income and a £50,000 gain, £20,000 of the gain would fall into your lower rate, and that would attract the 10%, and the other 30, if I've got my maths right, would attract the 20%. So, but I think what they've done on the timing, it isn't uncommon for them to change a rate that is effective from this morning. So it's not like if people didn't get stuff sold yesterday, and of course a lot of people did get stuff sold yesterday in order to benefit from the 10 or 18% rate, or more likely they were looking to sell businesses and they were concerned about the business asset disposal relief allowance, just going completely. So they they've done it differently for both things, which is actually quite smart. So it's very clear on this. So your non-business assets, which are not residential property, so your commercial property, your stocks and shares that you've got in your normal portfolio, if you had delayed selling those, you are now straight into that higher rate. But it's not anywhere near as bad as we thought. I
mm,
suppose
yeah,
we were fearing rates being aligned with income tax, which would have made no sense because without indexation allowance, um, uh, it wouldn't be you'd be taxing more than the economic gain. Now, where it gets really interesting, of course, is what a lot of people were concerned about was business asset disposal relief going all together.
yeah,
It hasn't gone, but the rates are creeping up. And this is also quite smart because this will encourage people to sell stuff. That raises quick revenue. That plugs the 40 billion or the 22 billion. So we're okay. We've got until the 6th of April 25 to get the 10% rate. And so a lot of people will be pushing forward with those sales if they couldn't get them done before yesterday. But then from the 6th of April, that 10 goes to 14. And then the following year, to the 6th of April 2026, it goes to 8. Sorry, 8 to 18.
mm,
So it's £1 million. So the simple way to think about it is that if you can get it done before the 6th of April, you could save yourself 8% of £1 million, i.e., £80,000 that you would be paying extra after the 6th of April 2026. So I suppose not anywhere near as bad as we feared, and probably that's why they do this, isn't it? They put out the scary numbers, so when you do get it, you think, oh, that's not so bad. I can live with that.
yeah, yeah. Yes, there was a lot of fear mongering going on, and actually the government did keep quite a tight lid on these changes. Normally something leaks out, but we hadn't. They really kept this quite close to their chest.
Well,
So
they want to leak out the big numbers so people
yeah,
run around and sell stuff,
scare
so
us
it
all.
raises a lot of
Yeah,
quick
yeah,
revenue. It'd be interesting to
yeah,
see the capital gains tax receipts just for the period up until the budget.
yeah. So not too much on capital gains tax. Inheritance tax, quite interesting. The nil rate band thresholds, even though they introduced the residence nil rate band in 2017, the nil rate band, which is the first 325,000 of an estate, hasn't increased since 2009 and will be frozen until 2030. So we've got that, and then we've got changes in business property relief and agricultural property relief. Currently, estates now, qualifying business assets are currently exempt, but from April 2026, only the first 1 million will be exempt, with the balance being taxable effectively at around 20%. So, that's going to make quite a difference. Obviously, for completeness, the current reliefs are 100% and 50%, depending on ownership of assets, but there's no details yet on how these will be treated. But that's quite a high level comment on the rates and this £1 million being introduced as an exemption instead of almost like an unrestricted relief.
Yeah,
So,
that's I we understand it's the combination. So if you happen to have a farm worth 1 million, happen to have a trading business worth 1 million, it wouldn't be as though both of those would be covered. You'd add the two together, and you'd have the first 1 million would be exempt, and then the second 1 million you have 50% relief, and so you pay an effective rate of 20%. So £2 million of business property or business property and agricultural property would result in a £400,000 inheritance tax bill potentially. It's a bit concerning because we don't know the detail of how and when that has to be paid, but there are lots of trading businesses that will be worth more than £1 million, which will attract an inheritance tax bill, but won't necessarily have the cash in that business to pay the inheritance tax, because that's quite common. That was very common. The detail we'll be waiting to see is, do you get as long as you do with non-business property to pay it? So if you inherit a house, you can pay the inheritance tax over 10 years with interest. The other problem, of course, is how do you get the money out of the company without paying more tax in order to pay tax, which is incredibly painful and frustrating. Now, currently, and I would expect it will stay the same, the company can buy back its shares if the purpose of that buyback is to pay inheritance tax, and providing there's been a base cost uplift on death, there shouldn't therefore be any tax on the share buyback. So these are details we're yet to see. So whilst it's going to be painful because that money's got to be fined, I would at least hope there's not further tax on extracting that money. Having said that, if you pay it over 10 years and each time you do a share buyback, well, the values might be going up, so you could have tax at that point. So that's going to go down incredibly badly, especially I would have suggested the farmers who might find it even more difficult to raise the sort of funds they need to pay their inheritance tax.
Yeah. And of course, we've got pensions. The only issue with pensions was inheritance tax. Now, we weren't sure whether there would be the 25% tax-free lump sum would go, or whether they would increase the age that you could draw your pension. But actually, the only thing that's come out at the moment is, with effect from April 2027, unused pension funds and death benefits paid into an estate are now taxable as part of that estate. So that's a change, where there was no implication on it. Now they're getting pulled into an inheritance tax charge.
Yeah, I think it's worth probably having a little bit of context on pensions, because there was so much in the way of rumours around the 25% tax-free lump sum, there potentially being less income tax relief on contributions. You know, people talk about pension contributions sometimes though as a bad thing, um, as though the government was giving wild tax breaks, which is a bit ridiculous. You know, it's always been the case that pension contributions are if you are tax deductible, because it's not like you're avoiding the tax, you're deferring the tax. You make savings during when you're working, and then when you've got the money coming out of the pension, you pay tax then. It
Yeah.
might well be that the tax rate you pay when you take the money out is lower, but to have this sort of odd situation, it may not be. So to have a situation where you're putting money in and they restrict your pension tax relief to 20%, but then you might be taking it out at 40%. That's ridiculous. So I think all those, I would like to think that we always have these rumors, and you might now think, well, actually, if this government hasn't changed that stuff, it's not going to be, you know, you hope it's not ever going to be changed, that promise has to be there, or people will not save into pensions, and everyone needs people to save into pensions, because those funds are then invested in UK, UK PLC.
PLC, yeah.
So what we did have was perhaps a bit overly generous, whereby you'd have a situation where they'd got rid of the lifetime allowance charge. This is broadly over £1 million there'd be a charge. They got rid of that, and that was really aimed, I think, at civil servants and doctors, because they were retiring early or doing less hours, which was no good for anybody. And they must have decided they couldn't have one rule for the civil service and one rule for everybody else. That would have been a very bad idea. So fairness is there, which is fine, it's good. But to have the inheritance tax relief on top, when you can put unlimited amounts into your pension, was, I suppose, extremely generous. And what was happening was that people were using pensions purely as an IHT saving. They weren't even drawing them. They were putting as much as they could into pension, knowing that they could pass them on to their children without there being an inheritance tax. So it will, I think everyone will have a different view, but it does seem to be, we've landed in a sort of a more sensible position, and the rest of the stuff is just rumors and has gone away.
Yeah. So, and then they mentioned non-dom, the non-domicile rules. So were going to be abolished. They did mention this before. All it means now, if you are a UK resident, you will pay tax on your worldwide income from April 2025. There's no real details come out yet. You'd expect to see them in the coming months, but that's the high level announcement, is that everybody living in the UK resident will pay tax on their worldwide income.
I think it's worth talking about, just because Labour have talked about it so much. But I think part of that is about the fairness debate, and it's more about the fairness and doing the right thing than it is about how much money it's actually going to raise. But in terms of, it won't affect most of our clients, because most of our clients will be UK resident and domicile. But actually, for UK residents, this actually could be a good thing. And I class my father amongst them, because he's the situation we currently had was a bit ridiculous, whereby you could be. So my father, as an example, has been resident in Belgium since 1978. But if he came back tomorrow, he would immediately be considered to be domiciled in the UK, and therefore subject to UK inheritance tax on his worldwide assets, so not just his UK assets. So it doesn't matter that he's earned all his money throughout his life in Belgium and put all his investments in Belgium or wherever it might be. The day he comes back to the UK say, well, actually, you never lost your UK domicile, so because you're back, so you're now going to pay UK inheritance tax. It will now be based on long-term residence, which is kind of what most countries do. It's kind of a sensible way. This domicile concept is bizarre and comes from common law and bears no logic. To put it onto long-term residence actually makes a lot more sense. So if you've got I don't know, David Beckham goes off to play for Real Madrid, he's not going to be subject to Spanish taxes on his worldwide assets the day he signs for Real Madrid. But they say to him, well, look, you can have 5 years before you've got to worry about your overseas assets. But then if you stay here after 5 years, come on, you're one of us now. That's what we're doing. But it's going to be 10 years. It's going to be 10 years. So for my stepfather, my father, he could come back here. He would not regain a UK inheritance tax domicile and therefore be subject to worldwide to UK IHT on his worldwide assets until he's been back for 10 years.
Mm.
I got a question. I have to come back to that question. The nice question because it's from Peter. Peter, you've destroyed my chain of my thought process. Where was I? So, but for people that are UK resident who decide they want to go and retire abroad, after 10 years, they will lose their UK IHT status, so they will not be subject to UK inheritance tax on their worldwide assets. So it kind of levels the playing field and actually could be beneficial to UK individuals. But again, but equally, it could mean that those people look at it and go, "Well, crikey, the £325,000 nil rate band. I might have two of them. I'm not going to get the residence nil rate band because that'll be tapered to nil. It's wet here. Do you know what? I think I might go and retire to the Algarve. And if I do it early enough, because I now need to spend my pension because I'm not paying 40% inheritance tax on it. So it might encourage people to retire early, spend their money, and go and be somewhere where they can lose their UK inheritance tax position."
Yeah.
So where's that lovely question? And maybe I have to ask Peter just to explain it to me. So the pension changes penalise private individuals.
Yeah.
And avoid civil servants, doctors. Well, this is a disgrace. I can't be political, Peter, but straight back, we are non-political.
This is about six,
Peter,
really.
Peter can be. Peter be as political as he likes.
Yeah.
It's a disgrace and messes up dynamic. IHT planet's been in place over 10 years. So I think, and Peter can jump in if I've got this wrong, whilst we kept the annual allowance that hasn't come back, the way it works for kind of the civil servants and the doctors is they don't have a big pot of money. They have a promise of a very nice pension. And whilst that pension won't necessarily, I think what happens typically is it doesn't completely die with them. It goes to their spouse, or the spouse will maybe get 50%. But there's still a value to that sort of thing. So that can't be subject to inheritance tax.
Whereas no, because it's like a salary. It's a salary payment effectively.
I think Peter makes a good point that there is a sort of a discrepancy in the fairness between. There's still a bit of an unfairness.
Yeah.
But it could have been a lot worse if they decided to bring back the lifetime allowance for private pensions but exclude the civil servants.
Yeah, I did put a little note for you, Peter, actually, just saying IFAs will need to consider this change. So over to you at some point, isn't it? But
I got a comment here from I think it must be Ray. So he's going back to New Zealand for 10 years. What else have we got? I don't. If anyone's got
we've got a little bit of a sweep up. Yeah. So we've got stamp duty land tax, but that's only relevant to England. They're increasing their rate by 2% to 5% on second properties. So that's. But we don't know what Welsh land tax is going to do. Whether the Welsh government will follow suit, because those taxes have devolved. But currently, that's the impact in England, is that SDLT is going up. And
that
then
will be quite interesting in Wales, because England has now leapfrogged us, haven't they? So it used to be 3%. So this is the extra stamp duty on second properties. And just as a word for everyone, because no lawyer ever seems to understand this, it doesn't matter how many properties you have. if you are replacing your main residence, you do not pay the extra 3%, 4%, or 5%, whatever it happens to be. You do not pay the higher rates if you are replacing your main residence. Now, ideally, you sell at the same time you buy or sell before you buy. But even if you have to buy and then sell, you can go back and claw back the difference. It's a bit of a faff, but you don't pay the higher rates when you're replacing your main residence. But going back to the rate, the rate applies to the whole amount. It doesn't start at the thresholds. It applies to the whole amount. We all started with 3%. Wales went to 4%, and now England have gone to 5%. So it will be interesting to see if Wales follow suit. And does that mean they go to 5, or does that mean they go to 6?
Yeah.
They feel like the Wales feels like it's got to be more punitive than England. I don't know. That's a question for
another day.
I forget who's in charge now, because the last one got fired, didn't he? So I can't remember.
Yeah, but that's about it. And electric vehicles, really, the government is still supporting electric vehicles. That hasn't particularly changed. In terms of companies, no real changes there. Corporation tax rates are unchanged. Plus, the annual allowance, everything's still in place. No changes. So we are where we were with corporation tax. The main headline is all to do with the national insurance and capital gains tax, inheritance tax.
I think there was one that someone pointed out to me, which looked like a double U-turn on double cab pickups. So I don't know if anyone noticed, but double cab pickups, at one point they were going to be treated as cars for benefit in kind purposes. So historically, a double cab pickup has been considered a van, and so the benefit in kind tax has been much reduced. It's based on a fixed amount. I can't remember what it is, but it's quite generous. And then at some point, I think, a few months ago, the revenue said, I think it was a case or something, that decided no, they should be subject to the car benefit in kind tax, which will depend, depending on the emissions and all that, but would be a lot more expensive. And then they very quickly U-turned on that. There was a lot of upset, and mainly from farmers. This is ridiculous. How can we've already bought these vehicles, now we suddenly got to pay more tax. How could we possibly have known? But in the UTLAR, which is the acronym for the document, which is, I can never remember what it stands for actually. So the UTLAR is the overview. No, it escapes me. But I noticed in there that it's back. I'm not sure when from, but it looks like we're going to be paying car benefit in kind tax on double car pickups, and they just sort of, I guess, they've snuck it in behind everything else and said nothing about it. So that might come out in the following days. Was there anything else of any real note? Business rates, they're going to soften the increase. So that I haven't got the detail of that, but I think it was going to be a cliff edge, and they've softened that. So that's one to look out for.
Yeah, and the other thing was that HMRC, they're going to increase their debt management team.
One thing, did you hear they said about interest rates?
Yeah, they're going to increase the interest rate on overdue tax.
I couldn't see anything about what.
I haven't seen what the rates will be, but no. So they want to chase people who are delayed in paying their tax, basically. So they want to increase the debt management team to chase in the outstanding tax bills, and they want to increase the rate, which is currently 7.75% on outstanding tax.
It's not cheap, but I suppose
it's quite a hefty rate, yeah.
But I think the issue has been that if I'm looking to borrow money and I don't want to go to the bank, I don't want to pay an arrangement fee, and I don't want to pay it back every month regularly, you could say that HMRC are a very cheap and convenient form of credit. Maybe they've woken up to that to borrow money on the terms that the revenue given to you, or inadvertently give to you, you would borrow from HMRC. you would borrow from HMRC, you wouldn't go somewhere else. So they may
Yeah.
be, with the increased interest rates, they may be thinking, well, actually, people are using us as a form of credit. We had some questions, but I think Andrew's answered them in the chat. Oh, hang on. There's more questions. So one of the questions was just a clarification on the dates, which I think Andrew has put in the chat. So the just the regular rate, so not the rate for business asset disposal relief. So we've got the 18.
So the regular rates are effective from today.
That's the
The
18 and the
increase to 18 and
24.
24, yeah. And then anything else will be from April 25 onwards. But yeah, that one's coming in. Also, the investors relief, which is a quirky relief, that's been reduced to from 10 million to 1 million, and that's effective from today as well. But yeah, the standard rates, if you like, of capital
Yeah.
gains tax, they're
I think
increasing from today.
I think someone here is in shock about the agricultural relief
Yeah,
and this idea that you only have the first million and then the relief
yeah,
restricted to 50%. What will be quite interesting, and I haven't seen that this can't be done, but at the moment you can usually gift these assets without paying any capital gains tax. You can hold over the gains. So I think what this might lead to is people go, well, actually, I need to be clever about this. I need to gift these assets, live the 7 years, and then they'll be outside of inheritance tax completely. So I think there's still planning that can be done. We were fearful that the 7-year rule might be extended out to 10. So I'm not happy with it, but I think there are things that could potentially be done, which wouldn't necessarily be a bad thing to do, which will avoid both the inheritance tax and the capital gains tax. That will be difficult if there's debt. It's difficult to sometimes to make gifts if there's debt. So that hopefully that clarifies that. I think I got a question from so the question from Sharon. So the CGT rate is the same for trusts. There's no difference whether it's a trust or an individual. Companies don't pay CGT, they pay corporation tax, but trusts and individuals are treated the same. Stuart's asked me an impossible question. If the increase is this is the NI. If the increase is £806 per person on an average salary of 29,600, 2.7 increase, which is essentially buying a pay rise for next year. So I think what Stuart is saying, I won't say where Stuart is from. I think what Stuart is saying is no one's getting a pay rise next year. But I think there's a lot of truth in that. It's because, and I think we've got to blame the Conservatives, because if they hadn't have reduced employee NI, which of course they couldn't then increase, they had to claw it back somewhere else. So if employers just want consistency more than anything else, they just want to know where they are. If they'd at least have known, then that would have gone into their budgets and they'd have worked out what they might do. So I think it's going to take a little time for us all to reset. I think we will, but I wish politicians would stop being politicians and just grow up. And that's, I think that's fine to say that, and that's a straight bat thing. That's not party political. That's just, they need to all act like grown-ups. The NI changes, I think they all come into effect from the 6th of April. It's not.
Yeah, no, I think it's the start of the next tax year. Yeah, so it's not immediate, because we had that shambles a couple of years ago when Jeremy Hunt changed the rates during the year, and it was an absolute nightmare. So that this time they're just running it from the start of the next tax year.
Yeah, and that's unusual. So it's quite common that the CGT rate will change straight away, because they can do that. They introduced the reduction because they were going to lose the election, right? So they wanted to do something before they lost the election, and to stop, I guess, Rachel being able to reverse it when she's won the election. So, that's for next year. I think there's one other question here as well.
There's another interesting point, actually. The personal allowance, which at the moment is £12,570 that you can earn or receive your pension income at, is going to be increased by RPI from April 2028. Now, that's been frozen for many, many years. So they are starting to increase the personal allowance. Obviously, we've still got to wait for it, but at least that's going to come into effect. Hopefully that will help pensioners whose state pension at the moment is starting to exceed the personal allowance. And historically, the personal allowance was in place for pensioners so that if they only receive state pension, then the personal allowance would cover that. So they would never get pulled into the tax system. And obviously people have occupational pensions now as well, but that issue, with them not increasing the personal allowance by RPI over the years has seriously impacted pensioners. So hopefully that will help them some point in the future.
Yeah, absolutely. And I think, while she spoke for a long time, I think a lot of it was about setting the context and of the harm that had to be repaired. The only thing that really got a cheer was reducing duty on draft beer, which I just thought was very, very odd.
For the working people.
Yeah. But yeah, I think that's a pretty good summary, and then we'll have to see what comes out in the detail.
Yeah.
And of course, sometimes when they announce things that are for the future, by the time you get there, they change.
Yeah.
So we shall have to see.
Yeah.
But unless anyone has got, oh, I think I've got another question. Oh, I got a question not popping up after a question. So I think a question from Arwell about the increase in the employer's NI. Yeah, these changes will apply from April 20. So both the reduction in the threshold and the increase from 1.2 to, sorry, increase of 1.2 to 15%.
Yeah.
From the 6th of April, which is after the mess. That's good. It's
makes sense.
It's difficult enough for employers to deal with pay as you earn as it is sometimes, without making it any more difficult for them. And gives us a little bit of time to, I suppose, manage expectation with employees around, we're going to have a really tough time next year because we've got these extra costs, and some time to lead in those price increases, because that's what's going to have to happen, I suppose, is prices will have to increase. And of course, the perverse thing is that the people who are then most impacted by an increase in prices are the lowest paid. So unfortunately, unfortunately, it can be difficult. Another question here: impact on farms countryside could be devastating. Might be a strong lobby. Could be strong lobby at NFU, and we've got our own sort of version of the NFU in Wales, which is the FUW, the Farmers Union of Wales, and they do lobby, and they are quite influential, I think. I will have to wait and see. I don't think you can legally challenge a chancellor's decisions in the budget, but there could be some very, very concerned. There will be some very concerned people about how on earth that those taxes are going to be paid. And I think what the government says, well, look, we'll give you 10 years to pay it. That's not, but there's interest on that. I don't think there's there's much that can soften that. It's I don't want to be political, but it does worry me.
Yes.
But
I agree.
Elwyn can be political. Yes, population of the countryside could be decimated, but I'm not going to disagree with Elwyn.
Yeah.
But, I need to be careful what I say.
And I think on that note, if there's no other questions, I think we could probably wrap up.
Yeah, we've done 47 minutes.
Yeah, so but there will be more information coming out, obviously, in the coming days once we've got drilled down into the small print. But we thought it was important to just cover off some of the main points that we gleaned from today.
Yeah, and there's always things that can be done, and we don't, we call it mitigation. That's the nice way of putting it. There's always, so speak to a good accountant. Okay.
Yeah. Okay, so thank you everybody, and
thank you, everybody.
enjoy the rest of the day. Thank
Take
you.
care.